You know what the difference is between how you experience a market crash and how a billionaire experiences it. You see your portfolio down 30% and feel terror. They see the same crash and feel excitement. Why? Because when markets collapse, they have access to a completely different set of investment opportunities, distressed assets, private deals, structured products, that can return 20%, 30%, sometimes 50% when everything else is falling apart. So here's the question nobody wants to answer. Why are these opportunities only available to the ultra-wealthy? And more importantly, what are we doing to change that? Before we go further, I'd appreciate it if you could support this content by liking the video and subscribing to the channel with notifications enabled. It helps us continue bringing you this kind of analysis. I've been in this business for almost 50 years now. I started on Wall Street in 1976, and I can tell you with absolute certainty, the game has never been fair. Not because there's some conspiracy, not because the wealthy are deliberately keeping people out, but because the architecture of capital markets was built layer by layer over centuries, and each layer created access barriers that became harder and harder to cross. And most people don't even know these barriers exist. They think they're playing the same game as institutional investors. They're not. They're playing a fundamentally different game with fundamentally different rules, fundamentally different access, and fundamentally different outcomes. Let me paint you a picture of what I'm talking about. March 2020. The pandemic hits. Markets crater. The S&P 500 falls 34% in 5 weeks. If you were a typical retail investor with money in a 401k or an IRA, you watched your life savings evaporate. You felt sick. You couldn't sleep. Maybe you panicked and sold, locking in losses you'd spend years trying to recover from. And I don't blame you for that reaction. That's a completely human response to watching decades of careful saving disappear in weeks. But here's what was happening on the other side of that same market. Institutional investors, sovereign wealth funds, ultra-high net worth family offices, they weren't panicking. They were deploying capital at a pace I hadn't seen since the 2008 financial crisis. They were buying distressed debt at 40 cents on the dollar. They were acquiring majority stakes in solid companies whose stock prices had been cut in half for no fundamental reason other than panic. They were structuring private credit deals with returns north of 15% when government bonds were yielding essentially zero. They were purchasing real estate assets from forced sellers at discounts that wouldn't be available again for a generation. And by August 2020, just 5 months after the bottom, when retail investors were still paralyzed with fear or just starting to feel brave enough to get back in, these institutional players had already locked in gains that would compound for years. They didn't time the bottom perfectly. They didn't need to. They had something more valuable than perfect timing. They had access to a parallel investment universe that most people don't even know exists. Now, I run BlackRock. We manage over $11 trillion. That's more money than the GDP of every country on Earth except the United States and China. And every single day, I see this wealth gap play out not just in outcomes, but in opportunities. I see pension funds allocating 25% to 30% of their portfolios to private assets, infrastructure, private equity, private credit, real assets, and generating returns that consistently outperform public markets. I see university endowments at places like Yale and Harvard with 50%, 60%, sometimes 70% of their portfolios in alternative investments, compounding wealth at rates that seem almost unfair when you compare them to what the average person can access through their workplace retirement plan. And here's what frustrates me. What keeps me up at night? This isn't a small difference. This isn't a rounding error. Over a 40-year investment horizon, the difference between a pension fund's returns and a typical 401k's returns is about 0.5 percentage point per year. 0.5%. That doesn't sound like much, does it? But compounded over 4 decades, that 0.5% difference translates to having 14% to 15% more wealth at retirement. For someone trying to retire on $1 million, that's the difference between $1 million and $1.15 million. That's an extra $150,000. That could be 2 or 3 additional years of financial security. That could be the difference between a comfortable retirement and one where you're constantly worried about money. So when people ask me why wealth inequality keeps growing, why the rich keep getting richer even during economic crises, this is a huge part of the answer. It's not just that wealthy people have more money to invest. It's that the money they do invest has access to fundamentally better opportunities. They're playing a different game on a different field with different equipment. And the gap compounds. Every market cycle, every crisis, every recovery, the gap gets wider. I've said this publicly, and I'll say it again here. We have twin inverted economies in most developed countries. One where wealth builds on wealth, another where hardship builds on hardship. And the dividing line isn't just income. It's not even just wealth. It's access. Access to the investment structures that create generational wealth. Access to the opportunities that emerge specifically during moments of maximum fear and dislocation. Access to the patient capital strategies that don't need liquidity tomorrow because they're built for returns 5, 10, 15 years from now. Let me give you a concrete example of what this access gap looks like in practice. After the 2008 financial crisis, distressed debt funds raised tens of billions of dollars to buy up mortgage-backed securities, corporate bonds, and bank loans that had been sold off in the panic. These weren't toxic assets. These were good assets that had been mispriced because of forced selling and liquidity crunches. Institutional investors who had access to these distressed debt funds saw returns of 20%, 25%, in some cases 30% annually as those assets recovered to their intrinsic value over the next 3 to 5 years. Meanwhile, retail investors who were invested only in public stocks and bonds had to wait for those same public markets to grind their way back to pre-crisis levels, which took years longer and delivered returns in the single digits over the same period. Same economic recovery, same fundamental improvement in the economy, completely different investment outcomes based entirely on access. Or take infrastructure investing. Over the last decade, institutional investors have poured hundreds of billions into essential infrastructure. Ports, toll roads, data centers, power grids, water systems. These assets generate steady, predictable cash flows. They're largely insulated from economic cycles because people need electricity and water whether the economy is growing or contracting. They have built-in inflation protection because many infrastructure contracts are explicitly indexed to inflation. And they're virtually uncorrelated with stock market volatility. When the S&P falls 20%, your infrastructure investment in a portfolio of electrical transmission assets doesn't fall with it. It just keeps generating the same steady income it was generating before. Pension funds know this. Sovereign wealth funds know this. That's why they've been systematically shifting allocation to infrastructure for the past 15 years. But until very recently, if you were an individual investor, you had essentially no access to this asset class. You could buy stocks and bonds. You could buy mutual funds and ETFs that gave you exposure to stocks and bonds. But direct ownership of infrastructure assets? Private credit deals? Distressed debt opportunities? Those were locked behind minimum investment thresholds of $5 million, $10 million, sometimes $25 million. They required accredited investor status. They required lock-up periods of 5, 7, 10 years. They were, by design and by regulation, accessible only to institutions and the ultra-wealthy. And here's where I want to be very direct about something. This wasn't an accident. This wasn't some natural evolution of markets. This was a deliberate choice embedded in regulation, in fund structure, in the entire architecture of how alternative investments were built. And for decades, there were good reasons for those barriers. Private assets are illiquid. They're complex. They require sophisticated due diligence. The assumption was that retail investors needed to be protected from these complexities, that they couldn't handle the risk, that they didn't have the expertise. But here's what that protection actually accomplished. It protected retail investors right out of the wealth-building opportunities that defined the last 40 years of investing. It protected them from the returns that institutions and wealthy families used to compound generational wealth. And meanwhile, the risks they were being protected from? Those risks didn't disappear. Retail investors still faced market risk, still faced inflation risk, still faced longevity risk, still faced the risk of running out of money in retirement. They just faced all of those risks with access to a narrower, less diversified, lower returning set of investment tools. I remember when we launched our first retail accessible private markets products. The pushback was intense. Regulators worried about liquidity mismatches. Industry veterans said retail investors wouldn't understand these products. Financial advisors questioned whether their clients were sophisticated enough. And I understand those concerns. I really do. These are legitimate questions about investor protection and financial stability. But here's what nobody was asking. What's the cost of not giving people access? What's the cost of keeping 90% of investors locked into a 60/40 portfolio of stocks and bonds when institutional investors have moved to 50/30/20 portfolios that include private assets? What's the cost of telling someone they can't invest in infrastructure because they don't have $5 million, when that same person could absolutely handle a 5% or 10% allocation to infrastructure within a properly structured fund with appropriate liquidity terms? I've spent the last several years trying to answer those questions. Not theoretically, practically. At BlackRock, we've made some of the largest acquisitions in our history specifically to democratize access to private markets. We acquired Global Infrastructure Partners for $12.5 billion. We acquired HPS Investment Partners, one of the world's leading private credit managers, for $12 billion. We bought Prekin, a private markets data platform, to help advisors and investors better understand these asset classes. These weren't small bets. These were existential commitments to changing the fundamental structure of who gets access to what in modern finance. And we're not doing this out of charity. We're doing this because we believe the future of investing is not going to look like the past. The traditional model where retail investors buy stocks and bonds through public markets while institutions build diversified portfolios across public and private assets, that model is breaking down. It's producing outcomes that are economically unsustainable and, frankly, socially untenable. When half the population is worried they're going to outlive their savings while the other half is compounding wealth at double-digit rates in alternative investments, that's not a stable equilibrium. That's a crisis in slow motion. So the question I'm asking, the question that drives everything we're doing in this space, is simple. What would it look like to truly democratize access? Not with half measures. Not with products that are technically available but practically inaccessible. But with real, meaningful, structural access to the same opportunity set that institutions use to generate superior long-term returns. What would it take to build that? What regulatory changes? What product innovations? What distribution models? What investor education? Those are the questions I want to explore with you. Not because I have all the answers. I don't, but because I've spent 5 decades in this industry, I've seen what works and what doesn't, and I believe we're at an inflection point where change is not just possible, it's necessary. The old barriers are coming down, slowly but surely. The technology exists to make private assets accessible at scale. The product structures exist to manage liquidity and complexity. The regulatory framework is evolving to accommodate these changes. What we need now is a clear understanding of what these opportunities actually are, why they've been restricted, and how we can responsibly broaden access without creating new problems in the process. Because here's my conviction after all these years. Investing shouldn't be a game where the rules are different based on how much money you started with. It should be a system where good ideas, disciplined thinking, and long-term patience get rewarded regardless of whether you're managing $1,000 or $1 billion. And we're closer to making that vision real than we've ever been. That's what I want to talk about. That's what this conversation is really about. Not tips, not tactics, but a fundamental rethinking of who gets to participate in the full spectrum of wealth-building opportunities that modern capital markets have to offer. Let's explore that together. Let me take you inside how institutional investors actually think about markets, because once you understand this framework, everything else starts to make sense. When BlackRock's investment committee sits down to discuss portfolio construction, we're not asking, what's the hot stock? Or, should we time this market move? We're asking fundamentally different questions. We're asking, across a 10-year horizon, what are the structural forces that will reshape returns? Where are the inefficiencies that create opportunity? How do we build portfolios that can weather multiple economic regimes without requiring us to predict which regime comes next? This is system-level thinking. And it's completely different from how most individual investors approach markets. Most people are taught to think in binaries. Stocks or bonds, growth or value, domestic or international. But institutional portfolios don't work that way. They work in layers, in dimensions, in structures that create resilience through genuine diversification, not just through owning different stocks in the same public equity market. Let me break down what I mean by showing you how we think about the current opportunity set in private markets, because this is where the access gap I talked about earlier becomes most visible and most consequential. Start with private credit. This is an asset class that barely existed in its current form 20 years ago, but today represents over $1.5 trillion in capital deployed globally. What is it? Essentially, it's loans made directly to companies, bypassing traditional banks. After the 2008 financial crisis, banks pulled back dramatically from lending to middle-market companies because of regulatory constraints and capital requirements. That created a gap. Companies still needed capital, but traditional bank financing became harder to access, more expensive, and more restrictive. Private credit funds stepped into that gap. They provide financing directly to companies, and in exchange, They earn interest rates that are typically 400 to 800 basis points higher than you'd get on public corporate bonds with similar risk profiles. Why the premium? Because these loans are illiquid. You can't sell them on an exchange tomorrow if you change your mind. You're committed for the life of the loan, which might be 5 or 7 years. That illiquidity is a feature, not a bug, if you're an institutional investor with long-term liabilities. You get paid a significant premium for giving up liquidity you didn't need anyway. Now, think about what this means for returns. Let's say public corporate bonds are yielding 5%. Private credit on similar credits might be yielding 9% or 10%. Over a 20-year period, if you compound $100,000 at 5%, you end up with about $265,000. Compound that same $100,000 at 10%, and you end up with $673,000. That's a difference of more than $400,000, created entirely by access to an illiquidity premium that most investors can't capture because they're restricted to liquid public markets. Or consider private equity. The narrative around private equity has become somewhat distorted in public discourse, but let me give you the institutional perspective. Private equity funds acquire companies, typically using a combination of equity and debt, with the goal of improving operations, growing revenue, and eventually selling the company or taking it public at a higher valuation. The average holding period is 4 to 7 years. The returns have been compelling. Over the past 20 years, private equity has outperformed public equity markets by roughly 300 to 400 basis points annually on average. That doesn't sound transformative until you compound it. A pension fund that allocated 20% of its portfolio to private equity in 2000 would have generated meaningfully higher returns than one that stayed 100% in public equities, even accounting for the fees that private equity managers charge. Why does private equity outperform? Multiple reasons. First, private ownership allows for longer-term strategic thinking without the quarterly earnings pressure that public companies face. Second, private equity managers typically have deep operational expertise and can drive genuine improvements in the businesses they acquire. Third, the structure creates powerful alignment between managers and investors through carried interest. And fourth, there's a selection effect. Private equity funds are choosing companies they believe they can improve, rather than passively holding whatever's in an index. But here's the critical point. Until very recently, if you wanted exposure to private equity, you needed to be an accredited investor with significant capital to commit. Minimum investments were typically $250,000 to $1 million or more. You needed to be comfortable locking up that capital for a decade. And you needed the financial sophistication to evaluate fund managers, understand the fee structures, and assess the risks. These barriers effectively limited private equity access to institutions and the wealthy. Infrastructure is another asset class where the opportunity set has expanded dramatically, but access has remained constrained. Think about the infrastructure that powers modern civilization. The electrical grids that keep the lights on, the data centers that enable cloud computing, the transportation networks that move goods and people, the water systems that deliver clean water, the communication towers that enable mobile connectivity. These assets have several characteristics that make them extremely attractive for long-term investors. They generate predictable cash flows because demand is relatively inelastic. People need electricity whether the economy is booming or contracting. They often have natural monopoly characteristics or high barriers to entry, which means pricing power and stable market positions. Many infrastructure assets have explicit inflation protection built into their contracts. When costs rise, they can pass those costs through to users. And they're largely uncorrelated with traditional financial assets, which means they provide genuine diversification. Institutional investors have been systematically increasing their infrastructure allocations for 15 years. Pension funds, sovereign wealth funds, insurance companies, they're all moving capital into this space because it matches their long-term liability profiles perfectly. They need to make payments 20, 30, 40 years from now, and infrastructure assets generate the kind of steady, inflation-protected cash flows that fund those long-term obligations. But if you're an individual investor, until very recently, your options for infrastructure exposure were extremely limited. You could buy stocks of publicly traded infrastructure companies, but that gave you equity market volatility along with your infrastructure exposure. You could buy a handful of infrastructure-focused mutual funds or ETFs, but those were also trading on public exchanges and thus subject to the same market sentiment swings as any other stock. Direct ownership of real infrastructure assets? Not available. That required institutional scale capital and expertise. Let me give you a specific example to make this concrete. In 2019, BlackRock's infrastructure team invested in a portfolio of data centers across the United States and Europe. These are the massive facilities that house the servers running cloud computing, streaming services, artificial intelligence applications, essentially the backbone of the digital economy. The investment thesis was straightforward. Demand for data storage and computing power is growing exponentially. Data centers are expensive and time-consuming to build, and once they're operational, they generate very stable cash flows under long-term contracts with companies like Amazon, Microsoft, and Google. That investment is performing exactly as expected. The data centers generate consistent income, valuations have appreciated as demand for data center capacity has exceeded supply, and the cash flows are providing steady returns regardless of what's happening in public equity markets. An institutional investor who participated in that deal is compounding wealth at a rate that simply isn't available in traditional 60/40ths portfolios. But an individual investor had no way to access that opportunity under the old model. Now, I want to address something directly because I know what some of you are thinking. Larry, this sounds great, but aren't you just describing riskier, more complex investments that regular people shouldn't be involved in? Isn't there a reason these barriers existed? And that's a fair question. It deserves a serious answer. Yes, private assets are different from public stocks and bonds. They're illiquid, which means you can't sell them quickly if you need cash. They're complex, which means they require more due diligence to understand. They often have higher fees because active management is required. And they have different risk profiles, sometimes lower correlation risk but potentially higher operational or credit risk depending on the specific investment. But here's what I've learned after decades of managing these assets. The risk of not having access to private markets may be greater than the risk of having access, especially for long-term investors. If you're 35 years old and investing for retirement at 65, you have a 30-year time horizon. Illiquidity over 3, 5, or 7 years isn't a meaningful constraint for you. You don't need that capital to be available tomorrow. What you need is for it to compound at the highest risk-adjusted return possible over 3 decades. And if private assets offer meaningfully higher returns for that long-term capital, restricting your access to them isn't protecting you, it's handicapping you. The key is structure and education. You don't solve the access problem by telling someone to put their entire portfolio into illiquid private equity funds. That would be reckless. But allocating 10% or 15% or 20% of a long-term portfolio to private assets within properly structured vehicles that manage liquidity, that provide diversification, that charge reasonable fees, that offer transparency, that's not reckless. That's smart portfolio construction. That's what institutions do. And there's no principled reason why individual investors with long-term horizons shouldn't be able to do the same. Let me give you the numbers that drive this conviction. We've done extensive analysis comparing pension fund performance to 401k performance over the past 20 years. The typical pension fund has returned about 7% annually. The typical 401k has returned about 6.5% annually. That half-point difference, as I mentioned earlier, compounds to a 14% to 15% wealth gap over 40 years. What explains that gap? It's not that pension fund managers are smarter. It's not that they have better market timing. It's asset allocation. Pension funds have 20% to 30% in private assets. 401k plans are almost entirely in public stocks and bonds. That's it. That's the explanation. Access to a broader opportunity set produces better long-term outcomes. And we have 20 years of data proving it. Now, what's changing? Why am I optimistic that we can actually democratize this access in a meaningful way? Several structural shifts are happening simultaneously. First, product innovation. We're building investment vehicles that allow for fractional ownership of private assets with much lower minimum investments. Instead of needing $1 million to access a private equity fund, you might need $10,000 or $25,000. Instead of a 10-year lockup with no ability to access capital, you might have semi-annual liquidity windows that allow for measured redemptions while still maintaining the long-term patient capital structure that makes private investing work. Second, regulatory evolution. Regulators are beginning to recognize that investor protection can't only mean limiting access. It also has to mean enabling access to the full spectrum of risk-adjusted return opportunities. We're seeing changes that allow for broader distribution of private funds through registered investment advisors, through 401k plans, through retail brokerage platforms, but with appropriate guardrails around disclosure, liquidity management, and investor suitability. Third, technological advancement. The infrastructure to manage, report on, and provide transparency around private investments has improved dramatically. 20 years ago, reporting on private assets was opaque and infrequent. Today, we can provide detailed portfolio-level reporting, risk analytics, and performance attribution in near real time. That transparency makes these investments more accessible and more governable for a broader investor base. Fourth, fee compression. Competition is driving down the cost of accessing private markets. The old private equity model of 2% management fees and 20% carried interest is giving way to more investor-friendly structures, especially for retail-accessible vehicles. We're seeing management fees of 1% or less and performance fees structured to align interests without extracting excessive value. And fifth, education and distribution. The financial advisory community is becoming more sophisticated about private assets. Advisors are learning how to incorporate these strategies into client portfolios, how to explain the risk-return trade-offs, how to manage behavioral aspects like illiquidity. That educational foundation is critical because the worst outcome would be to democratize access without democratizing understanding. So here's where we are. The barriers that kept 90% of investors out of private markets for the past 40 years are coming down. Not overnight, not all at once, but systematically, deliberately, structurally. And I believe this represents one of the most significant shifts in wealth-building opportunities in modern finance. Because for the first time, we're creating the possibility that someone with $50,000 to invest can build a portfolio that looks fundamentally similar to what a pension fund or endowment builds, properly diversified across public and private assets, positioned for long-term compounding, resilient to multiple economic scenarios. That doesn't mean everyone should rush to put half their portfolio into private equity tomorrow. That's not what I'm saying. What I'm saying is that the conversation can finally shift from, "You can't access this," to, "Here's how you might think about accessing this responsibly as part of a long-term wealth-building strategy." That shift in the conversation, that shift in what's possible, that's what matters. That's what changes trajectories over decades. So let's bring this all together and talk about what this actually means for how you think about building wealth over the next 20, 30, 40 years. Because information without application is just entertainment. And my goal here isn't to entertain you. It's to fundamentally shift how you think about the opportunity set available to you as an investor. Here's the mental model I want you to walk away with. Investing is not a single game with uniform rules. It's multiple games happening simultaneously on different fields with different participants and different reward structures. For decades, most individual investors have been playing one game, the public markets game, while institutions have been playing multiple games simultaneously, including the private markets game that offered fundamentally different risk-return characteristics. That structural difference in what games you have access to has been one of the primary drivers of wealth inequality over the past 40 years. Not the only driver, obviously. Income inequality matters. Educational access matters. Geographic opportunity matters. But when we isolate just the investment component, just the question of what your capital can access and how it compounds over time, the access gap to private markets has been enormously consequential. Now, I want to be very clear about something, because I think precision matters here. I'm not saying private assets are inherently better than public assets. I'm not saying everyone should abandon stocks and bonds and move everything to private equity and infrastructure. That would be foolish. Public markets serve essential functions. They provide liquidity, transparency, price discovery, and access to growth across the global economy. A well-constructed portfolio needs both public and private exposure. What I am saying is that a portfolio consisting only of public assets is structurally disadvantaged compared to a portfolio that thoughtfully blends public and private. The diversification benefits are real. The return enhancement potential is real. The inflation protection characteristics are real. And the ability to access opportunities during periods of dislocation, when public markets are panicking but private markets are deploying capital. That asymmetry is real. Think about what this means practically. If you're 30 years old today and you're building a retirement portfolio, you have 35 years until you're 65. 35 years. In that time frame, you're going to experience multiple market cycles, multiple recessions, probably at least one major financial crisis, significant inflation, technological transformation, geopolitical shocks. All of it. The question is not whether these things will happen. The question is whether your portfolio is structured to weather them and potentially benefit from the opportunities they create. The traditional answer has been diversification across stocks and bonds, domestic and international, large cap and small cap, growth and value. And that's good. That's better than being concentrated in a single stock or a single sector. But it's incomplete, because all of those diversification dimensions exist within public markets, which means they're all subject to the same systematic shocks, the same liquidity dynamics, the same sentiment swings. True diversification, the kind of diversification that actually changes outcomes over decades, requires exposure to return streams that are genuinely uncorrelated with public market volatility. And that's what private assets provide. When public equity markets fall 30% because of a liquidity crisis, your infrastructure investment in electrical transmission doesn't fall 30% with it. It continues generating the same cash flows it was generating before because people still need electricity. That's not theoretical diversification. That's real economic diversification. So when I think about the ideal portfolio structure for someone with a long-term horizon, I'm increasingly convinced we need to move beyond the traditional 60-40 framework. 60% stocks, 40% bonds worked reasonably well for several decades, but it's showing its limitations. In 2022, both stocks and bonds fell simultaneously. That wasn't supposed to happen. The whole point of the 60-40 allocation was that bonds would provide stability when stocks were volatile. But when inflation surged and central banks raised rates aggressively, both asset classes suffered. That's why I've been advocating for what I call a 50-30-20 framework. 50% stocks, 30% bonds, and 20% private assets. This isn't arbitrary. It's based on analyzing how different portfolio structures would have performed across multiple economic regimes, multiple inflation environments, multiple interest rate cycles. And what we find consistently is that adding a meaningful allocation to private assets, infrastructure, private credit, private equity, real assets, improves risk-adjusted returns, reduces overall portfolio volatility, and provides better downside protection during periods of stress. Now, implementing this framework requires thinking differently about several dimensions of portfolio construction. Let me walk through the key considerations. First, liquidity management. If you're going to allocate 20% of your portfolio to illiquid or semi-liquid private assets, you need to ensure the remaining 80% can handle your liquidity needs. That means maintaining an appropriate emergency fund in cash or cash equivalents, ensuring your public holdings are broadly diversified and liquid, and thinking carefully about the timing of when you might need to access capital. If you're going to need a down payment on a house in 2 years, don't put that money in a 7-year private equity fund. That's common sense, but it's worth stating explicitly. Second, time horizon alignment. Private assets work best for capital that has a genuinely long-term horizon. If you're 60 years old and planning to retire at 65, a 10-year private equity fund probably doesn't make sense for a significant portion of your portfolio. But if you're 35 and investing for retirement at 65, you have 30 years. A 10-year commitment represents 1/3 of your total time horizon. That's manageable. That's appropriate. The key is matching the illiquidity of your investments to the timeframe of your goals. Third, gradual implementation. You don't need to restructure your entire portfolio overnight. In fact, you shouldn't. A thoughtful approach would be to gradually build your private asset allocation over several years as opportunities become available and as you become more comfortable with these asset classes. Maybe you start with 5%, see how it feels, understand the reporting and the structures, and then increase to 10%, then 15%, then 20% as your knowledge and comfort grow. Fourth, diversification within private assets. Just like you wouldn't put all your public equity allocation into a single stock, you shouldn't put all your private allocation into a single fund or a single strategy. Ideally, you want exposure across different types of private assets. Some infrastructure, some private credit, some private equity, and within each category, exposure to multiple managers and multiple vintage years. This diversification protects you from manager-specific risk and vintage year-specific risk. Fifth, fee consciousness. Private assets typically charge higher fees than passive index funds, and that's appropriate given the active management and illiquidity involved. But fees still matter. A private equity fund charging 2% management fees and 20% carried interest needs to outperform significantly just to justify those fees. Increasingly, we're seeing more competitive fee structures, especially for retail-accessible private funds. Pay attention to what you're paying and what you're getting for it. Sixth, tax efficiency. Private assets can have complex tax characteristics. Some generate ordinary income, some generate capital gains, some may generate depreciation or other tax benefits. If you're investing through a tax-deferred account like a 401k or IRA, the tax complexity is less relevant. But if you're investing in a taxable account, you need to understand the tax implications and potentially work with a tax advisor to optimize your structure. Now, let me address the psychological dimension of this, because I think it's just as important as the financial dimension. One of the reasons institutions have been successful with private assets is that the illiquidity actually enforces discipline. When pension fund allocates capital to a 10-year private equity fund, they can't panic sell when markets get volatile. They're locked in. They have to be patient. And that forced patience typically leads to better outcomes because it prevents the behavioral mistakes that destroy wealth. Selling low during panics, chasing performance during booms, constantly trading in and out based on emotion rather than strategy. For individual investors, this forced discipline can be valuable, but it requires a mental shift. You have to accept that you can't check the value of these investments daily like you can with stocks. You have to trust the process, trust the managers, trust the long-term thesis. That's uncomfortable for people who are used to having complete liquidity and constant price transparency. But that discomfort might actually be protecting you from yourself, from the impulse to do something reactive when the disciplined choice is to do nothing. I'll be honest with you. I've seen incredibly smart people make terrible investment decisions because they couldn't handle the psychological discomfort of volatility. They had the right strategy, the right allocation, the right time horizon, but when markets fell and they saw their account balances drop, they couldn't sit still. They sold. They moved to cash. They missed the recovery. And they spent years trying to make up the ground they lost through that one emotional decision. Private assets, by being illiquid, remove that temptation. You can't panic sell if there's no one to sell to. You're forced to be patient, to maintain a long-term perspective, to ignore short-term noise. And for many investors, that constraint is actually liberating. It frees you from the anxiety of constantly monitoring and second-guessing and reacting. But here's the critical point. For this to work, you have to go into it with the right mindset. You have to genuinely believe in long-term investing. You have to accept that you won't have perfect information about valuations at all times. You have to be comfortable with opacity in exchange for returns. If you're someone who needs to check your portfolio balance every day and feel a sense of control, private assets might not be right for you, at least not for a large portion of your portfolio. And that's okay. This isn't about convincing everyone to invest the same way. It's about making sure people understand their options and can make informed choices. Let me talk about what I see happening over the next decade, because I think the trajectory is clear. The democratization of private markets is going to continue and accelerate. More products will be launched that provide access at lower minimums. More 401k plans will include private asset options. More financial advisors will incorporate these strategies into client portfolios. More regulatory clarity will emerge around disclosure, valuation, and liquidity management. And as that happens, we're going to see a gradual convergence between institutional portfolio construction and retail portfolio construction. Not complete convergence. Institutions will always have access to certain strategies that don't scale to retail. But meaningful convergence where the average person building wealth for retirement can construct a portfolio that looks fundamentally similar to what a pension fund or endowment builds. That convergence matters because it addresses one of the core injustices in modern finance. The idea that the wealthy get access to better opportunities simply because they're wealthy. That creates a compounding cycle where wealth begets more wealth not through superior knowledge or better decisions but through superior access. Breaking that cycle, creating genuine economic mobility through equalized access to wealth-building tools, that's not just good business. That's a moral imperative. I don't say that lightly. I've spent my career in finance. I understand how markets work. I understand incentives and efficiency and competition. But I also understand that markets exist within societies, and societies can't sustain indefinite expansion of wealth gaps without fracturing. We're already seeing the political and social consequences of extreme inequality. And while investing access isn't the only solution, it's a meaningful piece of the puzzle. So here's what I want you to take from this conversation. You have more options than you think. The barriers that existed for decades are coming down. The structures that limited access to private markets are being dismantled. The products that enable participation are being built. And over the next 10, 20, 30 years, how you take advantage of these expanding options will significantly impact the wealth you build. But expanding access is only half the equation. The other half is expanding understanding. You need to know what these assets are, how they work, what risks they carry, how to integrate them into a portfolio, what questions to ask, what red flags to watch for. That knowledge is just as important as the access itself. This is why I spend time doing this, talking about these concepts, trying to educate rather than just sell products. Because I genuinely believe that informed investors make better decisions, build more wealth, and create better outcomes for themselves and their families. And when that happens at scale, when millions of people are building sustainable wealth through disciplined long-term investing, that changes economies, changes communities, changes futures. I started by asking why the ultra-wealthy experience market crashes differently than everyone else. The answer, as I hope is clear now, isn't that they're smarter or braver. It's that they have access to a different set of tools, a different opportunity set, a different game. But that game is opening up. The access is expanding. The opportunity is there. The question now is, how will you use it? How will you think differently about portfolio construction knowing what you know now? How will you incorporate these concepts into your long-term wealth building strategy? Those are questions only you can answer. But they're questions worth asking. Because the answers will shape the next 30 years of your financial life. I've spent 5 decades in this business. I've managed more money than most countries have. I've seen every kind of market, every kind of crisis, every kind of opportunity. And I'm more convinced now than I've ever been that the future of investing is going to be more democratic, more accessible, more equitable than the past. Not because of altruism, but because the incentives are aligning, the technology is enabling it, and the economic logic is undeniable. Your job is to be ready for that future, to understand it, to position yourself to take advantage of it, to build portfolios that can compound wealth over decades regardless of what happens in any given year. That's how generational wealth gets built. Not through speculation, not through market timing, not through chasing the hot stock. Through systematic, disciplined, diversified, long-term investing across the full spectrum of available opportunities. That's the game. And now, finally, everyone can play it.